Hey guys, Sean here. Michael Burry believes the market crash, the carnage we are seeing isn't over yet. There's more downside to come and we are only halfway there. Now when he made this tweet, the S&P was at 3,800, down 25%. And if there's another 25% crash left, we are looking at the index plunging down to 2,850. So what we are seeing right now in the market, the S&P going back up to near 4,000. All these moves are fake. Burry believes it's a fake rally. It's a dead cat bounce. And if we are caught in it, there's still more pain to come. Now, more people are starting to wake up and liquidate their positions, and Michael Burry believes the big culprit, the enemy of the markets today, is inflation. And this is the thing we are all starting to realize. We are in a unique situation, a stagflationary crash, where we see asset prices crash down to earth, while inflation is still sky high for the things we need. Now, the bad thing of inflation is that it won't be solved anytime soon. And we are already in a recession from the Fed's own estimates, even if Janet Yellen is trying to deny it. So we have to analyze what his recent statements said, those famously deleted tweets of his, and see if we can give a timeline when the crash will fully play out, and most importantly, the signs we have to look out for. Now, his first tweet is rather cryptic. Burry says, what markets are going through is something they haven't had to deal with in over 4 decades. Yet today, all these chartists and analysts point to how great this or that strategy worked in the last 2 decades, and then he leaves us with two charts without mentioning anything else. Now, what Burry is saying here is that inflation is changing the game. We haven't had an insane 9.1% inflation rate for over 40 years, and we might need to throw out the rule book and previous trends because the landscape has changed. So if you take a look at the two charts, it shows us a previous correlation that worked in the past, and he is warning us it might not come true this time. Now, the first chart shows us that in March 2009 and May 2020, investors were buying more bonds than stocks. They were overweight in bonds relative to stocks. And during those periods, it normally followed a stock market rally, which he confirms in the next chart over here. But Burry is now warning that this trend might not come true. Things could be different this time, and it's because of the stagflation environment we are in. Economic growth is slowing, inflation is almost double digits. And if we investigate further, what Michael Burry is saying really makes a lot of sense. Inflation is truly changing the rules. Over the last 40 years, we have had declining interest rates and inflation was kept in check, hovering around 3 to 4% on average. This means that all the epic market rallies, the crashes, the trends, all these were based in an environment where borrowing was getting cheaper and inflation wasn't burning up people's paychecks like today. Now, that allowed businesses to borrow money and grow fast. This allowed people to consume and spend, but most importantly, everyone started to speculate in the markets like a casino, because if you just bought the S&P, you would enjoy an insane 10% return a year. But now things are changing. The conditions are different, and all our previous correlations trying to connect these to that might be as useful as astrology. And for many of us, that is frightening because we are now investing, we are now operating in the dark. Michael Burry brought up a very interesting point. He says that because of rising costs, food, fuel, and housing, American consumers will virtually exhaust their savings by this Christmas. And if you take a look at the personal savings rate, it is at 5.4% today, but it's cratering towards 2008 levels, which is a very bad omen for consumer strength. Plus, we also have economists coming out to say that the poor Americans have just 6 months left till Christmas before their money runs dry. And that means we'll see personal consumption expenditure start to crash. And every time it went down, we're already deep in a recession. So let's just project this out. If by December people are dead broke, this means that demand for goods and services is going to come down. If discretionary spending is destroyed, does this mean that inflation is going to come down and a recovery is on the horizon from early 2023 onwards? Because if consumer sentiment reaches an extreme low point, that could mean it might be the turning point for the economy. Now, according to Burry again, he believes that in December there will be a mixture of a drop in consumer spending that will cause slower economic growth. And to survive this weaker demand, many companies and retailers have to let go of their overstocked inventories at fire sale prices to survive. And this might be the final catalyst to bring down inflation, at least on the demand side. So if consumer spending craters and people have no choice but to charge stuff to their credit cards, this will mean companies' earnings will take a beating, right? And we all know what goes into stock prices, earnings. Now the S&P 500 today is around 39.60 and earnings is around $200, and this gives us a P ratio of around 20. Now if earnings drop by 10% by Christmas, this will give us a figure of 180, and let's just assume that the P ratio also corrects down to its mean of 16, because falling earnings normally mean a weaker stock market and people will be pricing equities at a lower multiple. So $180 times 16 gives us the S&P at 28.80, almost exactly Michael Burry's prediction of a further drop to 28.50 before this collapse is over. And this earnings recession is coming, right? We're already seeing earnings from many big banks crash thanks to lower mortgage demand, and many investors are bracing for bad earnings news from the tech sector. Now, I want to add that all these are estimates. Nothing ever plays out step by step, and it's impossible to pinpoint an exact price with a time frame. But we have to watch the earnings in December and see if stock prices collapse, because at that point, the Fed might suddenly do a U-turn and many investors are really betting on it, right? So just imagine if you're Powell, you see stock prices collapsing, people are spending less, GDP is falling, and most importantly, if inflation falls enough, you might end your rate hikes and end QT as well. You might suddenly just declare victory on inflation and start to reinflate the economy once again with cheap credit, funny money, or even just start giving people stimulus checks, right? To get people spending and businesses growing once again. Right now, investor sentiment is still in the toilet. If you take a look at the investor sentiment survey, we are still deep in bearish territory with less than 30% of people still bullish. However, we are beginning to see pessimism fall as people are slowly getting more optimistic about the market in the next 6 months, right? Now, I personally think that is premature, because while Michael Burry's outlook talks about lower consumer demand going forward and all these earnings crashing, there's also the issue of interest rates. It's the one big thing that's putting tremendous pressure on the economy. Many central banks around the world, including the Federal Reserve, are starting to hike rates, because if they don't, they will see their currencies literally depreciate and local inflation soar to the moon. We have the ECB finally hiking interest rates by 50 basis points, the first in 11 years, and it's likely they will keep going up and up. Germany's economy is slowing, and they are bracing themselves for a new spike in inflation by September. Now, unlike the Fed's dual mandate of low unemployment and price stability, the European Central Bank only has one primary objective, and that is maintaining price stability, keeping inflation at 2%, which I would argue is far easier than Powell's job. And this means if inflation continues to be high, they can just keep hiking rates 100 basis points, 200 basis points until they crush enough demand to bring down prices. And guess what? This will affect the US markets in a big way as well. A large portion of the S&P 500 is dependent on foreign revenues, and if the whole world starts hiking rates and consumer demand comes down, many companies will suffer badly, and this means we can see the US stock market as a whole crash even further. And this is why the markets will likely continue to fall, because global consumer demand is really going to the toilet as the months go by. And on the supply side, things aren't getting any better. The war in Ukraine is still raging on, the oil problem isn't solved, and could get even worse if Russia decides to cut supply if an oil price cap really comes into play. But are there any more signs from Michael Burry that will signal a bottom? Now, back in June, he tweeted this: "I don't think this is going to be over until everyone swears they will never own an NFT, they will never own crypto, and they will never own a technology stock." Basically, Burry is looking out for the complete collapse of investor confidence. We want to see investor apathy when people hate stocks, they hate tech, they feel crypto is the scam, and everyone just wants to puke hearing the word invest. Now, he went on to say that such was the sign in 2002, 1932, and 1974. And this is something we can all measure for ourselves through social media, through interactions in our daily lives. Just think back in 2021 when Bitcoin prices were peaking at 64 grand, everyone was investing in it, NFTs were flying off the shelves, Coinbase IPO'd at a crazy price, and everyone wanted to become a crypto billionaire. Now, just think about the situation today. We are seeing crypto exchanges like Celsius collapse, hedge funds like Three Arrows just vaporize, and Bitcoin crashing down to 20 grand. But there's still many bulls left, and people are still encouraging each other to buy the dip. So what Michael Burry is saying is that we need to see this last resistance turn bearish, we need to see the final survivors of the Bitcoin apocalypse just give up hope, and it might finally be over and we can usher back into a multi-year bull market again. Now, personally, I believe this is a good call, but we should also watch for the conditions that help set up the fantastic bull run that the S&P 500 had. We are talking about low interest rates and low inflation. And in this case, if in December or early 2023 inflation starts to come down, the Fed might start to lower rates, and if both of these go down enough, we could see the prices of every asset, especially stocks, start to rally once again. So obviously, we need to be aware that things could crash further. There could be another downside leg that could send the markets tumbling by another 20 or even 25% from where we are, and we shouldn't be too surprised. But this also shines a light on what we should be looking out from today all the way to December and early 2023. Are people charging more stuff to their credit cards? Are people buying less for Christmas? Are retail stores trying to clear their inventories with massive discounts? Because if inflation starts to fall and by some miracle the supply situation eases or the war in Europe is over, then we could really see the Fed move from hawkish to dovish. We could see a halt to the rate hikes, and that might be a good sign that things could be reversing and momentum could be building for a new bull market once again. But for now, at least to Michael Burry, the markets are going to collapse even further. In his most recent tweet, he's telling us that the current rally we are seeing in 2022 today is a dead cat bounce. And if this follows 2001, the dot-com bust, there's still more downside to come. The pain isn't over yet. So guys, hang tight and continue to watch the fireworks go off. I think Burry is one of the few contrarians out there who's smarter than the average investor. He has proven it in '08, and I believe he's correctly reading the room. He knows that the previous bull run was fueled by artificially low rates, and now the punch bowl or easy money is going away. This rally we are seeing probably won't last. Now, the official Q2 GDP numbers are coming out real soon, and according to Atlanta's Fed's GDP Now model, it's minus 1.5%. And if you combine it with Q1's number, that means we are in a technical recession, 2 quarters of negative GDP growth, the textbook definition of recession. So I won't be surprised if the markets tumble over the next few days and Michael Burry's prediction gets accelerated. We might not even need to wait for Christmas for the next leg of the implosion to happen, but whatever the case is, it's important to prepare like we're already in a recession and the markets are collapsing all around us, right? Stack your cash, get your promotions, close your business deals, because months down the road, it is likely liquidity is going to dry up and layoffs are coming. So let me know what you think. Do you believe the story Michael Burry is trying to sell? Will December be our lowest points before things start to recover? Let me know in the comments below. Stay safe, and if you enjoyed today's video, be sure to smash the like button and subscribe as we navigate together through this market crash. Thank you all for watching, and I'll see you soon.